Hi, my name is Anthony Cordelli. I'm a longtime trader and educator, and today I want to make an important distinction that many traders miss. Knowing your risk is not the same thing as managing it. Both are equally important. Knowing your risk means understanding the full scope of what could happen to your position and your account before you ever place the trade. Managing your risk, which we'll cover in the next video, is what you do while you're in a trade to control account and position risk. They work together, but they're different skills. Every trade carries risk, and before you hit that buy or sell button, you need to know exactly what kind of environment you're stepping into. Is this market active or quiet? Is volatility increasing or decreasing? Is the market trending or range-bound? Understanding how your trading style and plan fit into the current market setting can help you trade when conditions are favorable and sit out those times when they are not. Too many traders learn this lesson the hard way. They jump into a position, their market moves against them faster than they expected, and suddenly they're in damage control mode. Believe me, that's not where you want to be. Here are some best practices for knowing and controlling your risk before you trade. Start small. Begin with micro contracts. They give you more precise position sizing, which makes it easier to manage exposure while you build skill and confidence. Practice in the simulator. Before you commit real money, use a simulated trading account to test your strategy in real market conditions. Sim trading lets you see how different levels of volatility, contract sizes, and stop-loss placements affect your P&L without putting actual capital at risk. It's also a great way to build confidence and muscle memory before you go live. Learn the math. Calculate how any given price move will affect your P&L before you place the trade. Decide what stop-loss and profit target levels make the most sense for your probability of success. If you know that a 10-point move could cost you $500 and that's too large a percentage of your account, you'll know to adjust your trade parameters. Watch the calendar and headlines. Key economic releases and big news events can move the market fast, sometimes in seconds. Make it a habit to check scheduled events before you enter a position. CPI, employment reports, options expiration week, contract rollovers. These can often bring high volatility. Most of the time, it's better to sit them out and wait for the market to settle. Pay attention to volatility. Use tools like the VIX, ATR, or simple chart analysis to gauge market conditions. Unexpected spikes in volatility can be warning signs. A calm market versus a volatile one requires different strategies for position sizing and stop placement. Have a backup plan. Technology can fail. Platforms and data feeds can go down. Internet or power can cut out. Always have a plan for how you'll close or manage positions. If something goes wrong, NinjaTrader's mobile app can be a great backup solution. When you fully understand your potential risks and exposure, you're not just protecting your capital, you're giving yourself the ability to trade with clarity and confidence. And in many cases, you can avoid problematic behavior before it gets out of control. That's the foundation for everything else we're going to talk about in this series. And remember, in the next video, we'll talk about managing risk once you're in the trade, which is a whole different skill set. I hope you found this information useful. And be sure to tune into NinjaTrader Live each trading day for market insights and live trading with professional traders.